once again. Welcome to the latest webinar in the Veros RiskWire series. This year, or this edition, we're going to talk about the 2011 Mid-Year Technology Review. We want to focus on where we are in terms of the technology evolution in the mortgage space. Are we where we thought we were going to be at mid-year 2011? Are we behind? Are we on target? Are we ahead of schedule? And more importantly, what's going to happen for the next 6 months in 2011? As a bit of housekeeping, you are in listen-only mode. However, your participation is important. We want you to submit your questions throughout the presentation. We will try to get through as many questions as time allows. Please email your questions to epulscamp@veros.com, and I'll spell that for you, and you'll see it on your screen as well. It's epulscamp@veros.com. Again, we will try to answer as many of your questions as possible as time permits. We do have 90 minutes, so we will try to move as quickly as possible to not only give you our opinions, but also to get your questions addressed. So we encourage you to participate as the presentation goes forward by emailing your questions to the email address on your screen. Another bit of housekeeping for you, I have to say as part of our disclaimer, that the thoughts and comments and opinions are those of real estate professionals that have a lot of experience in the mortgage space. They are, however, not the thoughts of any particular company, regulator, or government entity. The comments, remarks, thoughts, opinions that you're about to hear are those of the presenters and the presenters only. By way of introductions, again, I'm Tony Garitano, Chairman and Founder of Progress in Lending. I'll be your moderator. Roger Godova is also on the call. He is the Chief Strategy Officer of Compliance Systems Incorporated. Nancy Alley is the Vice President, Product Management of Xerox Mortgage Services. Chris Gowan is Vice President, Sales and Marketing of Veros Real Estate Solutions. And finally, the lender perspective will come from Lisa Schreiber, Executive Vice President at TMS Funding Wholesale Lending. Our goal in putting together this panel was to put together subject matter experts that cover the entire life cycle of the loan, and finally to end the call with the lender point of view, talking to you about what their technology priorities have been for the first 6 months of 2011 and what's important to them going forward in the rest of 2011. For my part, I'll be the talking head moderator who gives you his thoughts on the industry, state of the union, and then forwards it off to Roger Godova. As you can see, our agenda is here. I'll talk to you a little bit about the mortgage technology landscape. Roger will cover documents and data. Chris will cover valuation management. Nancy will then talk about digital collaboration and paperless processing. Lisa will talk about the origination process from the lender's perspective. I'll then come back on and give you a little bit of a summary about what we as a panel think is coming up next in terms of technology. And then we'll try to get to as many of your questions as possible and part ways for the day at about 2:30 Eastern Time. As I said, I'm going to talk to you a little bit about the mortgage technology landscape. I'm going to talk for 5 to 10 minutes to frame the conversation and then pass it over to our esteemed colleagues that are on the panel to give you their areas of expertise and their subject matter expertise to share their thoughts about technology, where we are, and where we're going. For my part, here's the State of the Union. Where have we been? As we all know, there's been a complete economic collapse. We saw that in 2007 and 2008. What happened is we got a whole bunch of new regulations. I listed the first few that happened as a result of the collapse. MDIA, which brought about new disclosure information and new disclosure requirements. After that, the big one was RESPA. That happened in January of that following year. There was a big panic in the industry as to what are we going to do to comply with RESPA. Fortunately, most technology vendors were ready, most lenders were ready, and the transition was relatively smooth. What we've seen throughout these two regulations and all of the regulations that we experienced last year and into this year, the big one, of course, is going to be Dodd-Frank, is a greater emphasis on loan quality. You have to know more about the loan in terms of the data elements that go into the loan, more about the property, and more about the borrower. That, to me, is the great overriding theme that we're seeing. Also, in terms of market conditions, we're seeing increased defaults and foreclosures as a result of the subprime crisis. It is my expectation that it will take another 2 to 3 years before we get through all of the defaults and foreclosures and we get to a more normal period in the mortgage market. That means that home prices are most likely going to continue to decrease, at least this year. And we probably are not going to see any light at the end of the tunnel until at the very earliest next year. But again, that's just my opinion. I think it's substantiated by facts, and I think that we'll see that play out over the coming 12 to 18 months. Where are we now? There's a slow economic recovery. What do I mean by that? Job growth is next to nothing. And what we've seen is more recently, the unemployment rate has actually increased. So what does that mean for us? Obviously, if people are not working, if people continue to lose their jobs, they're not going to be paying their bills. They're not going to be buying a house. So we're going to see home prices decline, at least in the short term. The MBA predicted last year at the MBA annual that origination volume would decline by 40% this year as compared to last year. Unfortunately, that seems to be proving true, and we'll see what happens with the exact numbers as the year goes by. My expectation is that the 40% may even be a little conservative, and next year may be flat to minimal improvement. Again, we're going to go through the defaults and the foreclosures. Despite the government's best effort to alleviate the problem and to avoid foreclosures to keep people in their homes, it is my view that certain foreclosures are going to have to happen to flush out the market before we can get back to a state of normalcy. Where are we going? The bad news is there's even more regulatory change and more uncertainty. And I think that one of the things that really hurts us as an industry is the uncertainty. I'm sure you're with me when you say, we would rather know what's going on and at least deal with what's going on right now so that we can move forward. Unfortunately, I was at a seminar just a month ago presenting on the state of e-mortgages. One of the presenters expected that we have at least another 2 years of new regulation in front of us, and then beyond that, we have a transitional period as to what's going to happen with the GSEs. So we are looking at another 4 to 5 years of uncertainty. We work through Dodd-Frank and a host of new regulation, and then as we move into GSE reform. The Consumer Financial Protection Agency is going to be starting. What do we know about it? Aside from the fact that most people in the mortgage industry don't like it, what we also know is that they are going to be moving rather quickly ahead of schedule. They've already got this program out there that's called Know Before You Owe, where they're trying to streamline mortgage documentation, and they have 2 sample documents up on their website for people to view and comment on, even though the agency is not expected to get going until the end of the summer, early fall. What that tells me is that this government agency is going to work very quickly, that this government agency is very serious about regulating the mortgage industry, and that we are going to have to deal with a lot more regulation as an industry. The bad part about that is also at that seminar that I alluded to earlier, there was a congressman that was speaking, and he admitted that even though he was one of the co-authors of Dodd-Frank, that he really didn't know very much about the mortgage industry. As we as an industry look at these regulations, that seems like a no-brainer to us, but it is very distressing when a congressman comes out directly in front of a crowd of mortgage executives and says, hey, we were writing Dodd-Frank and we didn't really know too much about the mortgage industry when we were doing it. One example that he gave was the example of a qualified mortgage. When they were writing Dodd-Frank, apparently they didn't think that there would be much issue around what a qualified mortgage was. They figured that the mortgage industry would just know what a qualified mortgage was. As we know, that is not the case, and that is a big issue going into the fall. Streamlined documentation is certainly going to be important, and what's also going to happen is more data-driven processes and documents are going to be mandated. Our panelists will talk about some initiatives that are coming out of the GSEs that you need to know about and that you need to be prepared for in the fall. And as I said, the new documentation is coming out of the Consumer Financial Protection Agency as well. Before we get to the double dip, more good news, of course, we're going to talk about the ever-changing secondary market a little bit. We don't know what's going to happen with the GSEs, obviously, in the long term. However, what I would tell everyone listening is that the GSEs are here today. They are the major investors, and my guess as an industry onlooker is that whatever any new investor does or mandates is going to take into account what has been done prior and put its own unique spin on it. So for those people, for example, that come to me in the halls and say, Tony, I'm not going to do e-mortgages because I don't know what's going to happen to Fannie Mae and Freddie Mac, I would say to you, Fannie Mae and Freddie Mac are not going to go away anytime soon, and they make up a huge percentage of the secondary market, as we all know. So now is the time to do initiatives like the e-mortgage. Now is the time to embrace a more data-driven process because when new investors come into the market, they are going to look to the GSEs as their guidance or for their guidance, and that's going to make a big difference because you're going to be ahead of the game. A potential double dip in the economy, I'm hearing more economists think that this might be a reality given the unemployment numbers and the stagnated growth that we're seeing. We'll see what happens in the future. The big takeaway for us as an industry is that we have to be more proactive. We have to take control of our company and our processes to make for a better mortgage process. We all know about the old 3 Cs. I'm going to talk to you a little bit about what they are and what you need to know. That might be a little bit different. I'll go through this rather quickly, and then I want to talk to you a little bit about the new 3 Cs that I think you should be aware of and where technology can help you before I turn this over to Roger. First, credit. You need to look beyond the FICO score. You need to get the bigger picture of the borrower. That means taking in non-traditional data points, non-traditional credit scoring, and you need to really use technology to help you get a better picture of who that borrower is and what their capacity, as we go into the next one, to repay the mortgage is. When we talk about capacity, you need to check and double check. What happens when you get a mortgage is you get the 2 years of W-2s, you ask for the bank statement, they give you a bunch of paper, and then that's it. Well, that's not good enough anymore. You need to really know the borrower, you need to know their full economic situation, and you need to use technology to get to the sources that you need to get that information. The last one is collateral. You need to know about the property, of course, because that's what the mortgage is based on. But a typical valuation is not going to be enough. Relying on 3 traditional comps is not going to be enough. What one speaker suggested to me at an earlier presentation after he got off the stage was that you might even want to consider the FICO scores of the people who are in the 3 comps that you get as part of your valuation, because those 3 people may have credit scores, in the high 500s or low 600s, even though the house is still valued at X amount. That actually should decrease the collateral because some of those properties may soon go into default. The new 3 C's. Here's what you need to do going forward. Compliance, compliance, compliance. Of course, you have to automate compliance. It's way too much of a burden for any lender to do on their own. You have to be aware of new regulations, so keep up to date with RiskWire and other sources of information, but also lean on your vendors because they are subject matter experts and they can really help you get through this. Compliance isn't always a bad thing. You can use compliance as a competitive edge. For example, if MDIA, which we dealt with a year and a half ago, makes you embrace a concept like electronic disclosures, well, that offers the borrower a better process, and you can do a lot of creative things with electronic disclosures that is going to make for a better process. So be aware of compliance, talk to your vendor, and see how you can use compliance to further your process and to further your business goals. It's important that we as an industry be more proactive versus reactive. I talk to a lot of lenders about this piece of regulation or that piece of regulation, and they tell me, well, the deadline is not here yet, so I'm not going to worry about it. You need to worry about it, and you need to know about every piece of regulation so that you can use that to your advantage. Cost cutting. We all have to cut costs. We all have to compete. We all have to find new creative ways to engage with the borrower. You're going to hear some of our panelists talk a little bit later on about new and interesting technologies that are now available to you through things like social media. You have to engage the borrower in a more meaningful way. You have to compete with your peers in a more meaningful way. And the way to do that is to use technology to the fullest to isolate a process or a pain point and to use that process or pain point and expand from there. You have to focus on customer satisfaction and customer retention. It should all be about the customer, because what you need to do is you need to go out to the customer and grab their attention, because they're not going to come to you anymore. Lastly, you have to use these pain points, these new regulations, these new automation that you pick to improve your process. Lenders that don't think holistically during this period may find themselves out of business. I know that seems harsh, but you have to think about your overall process, your individual pain points, and how you can use technology and how you can use new regulation to improve your process. It's not just about filling holes anymore. Lastly, control. You have to know everything about your business. That means using business intelligence technology, dashboarding technology, virtualization, visualization. You have to know everything about your staff, because we are told that 85% of fraud happens from insiders, so you have to know who's doing what to the loan and when. You have to know everything about everyone that's involved in the loan, which includes outside parties like the appraiser, for example. So there's greater visibility that's required, but you can use that to craft a better business process if you're taking advantage of the technology that's on the market right now. With that, I want to turn it over to Roger Godoba. He's going to talk to you a little bit about document management and where we are in terms of document management at the halfway point in 2011 and where we're going into the rest of 2011. Roger?
Thank you, Tony. I'd like to talk a little bit today about documents and data and all the emphasis on data and how that will impact documents in the overall loan process. So where have we been? We've been chasing the paperless tiger. It's been more than 20 years ago when the industry started talking about the paperless mortgage. To see where we are today, let's take a brief look back in time. The first step towards paperless was to use electronic templates and overlay the data to create a static image. These images were delivered electronically and then printed to paper. The paper was then scanned back into an electronic format. So we didn't really eliminate the paper, but simply found a way to deliver and store documents electronically. Data was exchanged to order services such as credit, title, mortgage, insurance, and interface to the GSE's underwriting systems. In reality, documents drove the loan process and dictated the data required to produce them. This is still very true today. Later, we will talk about some new concepts. The idea to use XML for data emerged and replaced some of the proprietary formats such as X.12. I won't go into all the technical details, but XML provided an easily extensible and flexible format. So MISMO was formed about 10 years ago, and the first deliverable was the data dictionary. For the first time, everyone in the industry would be using common terms and definitions for the interchange of that data. This was a significant milestone for the industry. MISMO created XML transaction formats mentioned earlier for each of the services using the data dictionary as a base. The second deliverable was the development of the smart document that contained the document, the data that populated that document, and the link between them. The motivation was to have a process to validate that the data and documents were in sync. We are now in MISMO version 3, which is a single industry data model encompassing data and documents that bridge the gap between origination, closing, loan delivery, and servicing. You will hear a lot about this in all of these presentations. So where are we now? So if we look at the relationship between documents and data, as we progress from paper along the bottom to images, we have documents that are electronic, but they require some sort of intervention to attach or extract data from those images. If we look along the other axis, the 1003 data was the source for all the business-to-business transactions I mentioned earlier. But by combining those, MISMO version 3, we are combining the documents and the data. We have the ability to use technology to visually present documents and validate data for the complete loan transaction. This will provide the capability to do this 100% of the time and not rely on sampling 10 to 15% of the loans. And this will be significant, especially as new investors enter the marketplace. So where are we going? We are really migrating from a document-focused process to a data-focused process. If we think of the mortgage as an end-to-end data-oriented manufacturing process, not quite the same as making widgets, but any flaw in that process may result in an inferior product. So the idea is to capture data internally and externally early in the loan process, qualify and validate many times throughout the process. We want to leverage that information from multiple sources as a cross-check. In business rules, we use that information to drive and guide the process. So, get more data. I like to think of that as get more quality data. There's an initiative called the LQI, the Loan Quality Initiative. And so my first comment is, why now and why all of a sudden this urgency? Shouldn't we have been concerned about quality all along? Actually, as you will hear from others as well, we seem to be more concerned about quantity rather than quality. We're going to use data differently. Data by itself is just a collection of facts in the lowest level of abstraction. We call it information when we start identifying, classifying, and organizing that data. Think of the MISMO data dictionary. Then we call it knowledge when we have the intellectual capacity to understand and use that information. This is what will allow us the ability to control and manage the loan process based on data. And by the way, we love acronyms. The data initiatives underway based on version 3 are the UMDP, the Uniform Mortgage Data Program, the UCDP, the Uniform Collateral Data Portal, the ULDD, the Uniform Loan Delivery Data Set, the UAD, Uniform Appraisal Data Set. Everything is talking about uniform. We will hear about some of these in the following presentations. I believe the data-validated mortgage concept originated at Wells Fargo and is currently one of the current projects of the MBA ResTech Forum. I thought this was a very good slide to give you an overall view of what's really happening. So if we start at the left, know your borrower. It's like know your borrower like the old-time banker. As Tony mentioned, you have to know them really detailed. You can't rely on just the material that they're providing. So it's not enough today to simply validate the borrower's identity and income and assets and credit using the traditional methods. We will start using some non-traditional methods. So lenders are not only relying on a borrower to provide statements, bank statements, for example, but going directly to the banks to get copies to ensure that the numbers match what the borrower is providing. Some are using third-party providers to validate borrower information. Some are pulling credit application in a second time just before closing. But the end result is to examine the character, lifestyle, and financial behavior using data analytics. But one example I read, a recent article stated that when borrowers order pizza online, they become part of a vast database that lenders could access. So you think, well, what's that got to do with the mortgage? It's not about their lifestyle. It's where the pizza was delivered, and they could use that to validate where they reside. So in case the borrower is falsifying some of that information. All sorts of these data reservoirs exist today, and none of them are off limits to lenders. The only caveat is whether or not the information can be accessed legally, and it would be up to each of those situations to determine if it's beneficial to use in your process. But it's definitely something to think about. One of the disturbing situations I have come across recently is that there are companies that will create fraudulent asset or income documentation. They will supply a client with payroll check stubs, 1099s, W-2s, even toll-free numbers when someone calls to verify that they're an employee. One company has an asset rental program that places funds in a bank account so they can be verified. The borrower pays a fee to this company based on the amount and time that he has that fund in that account. He can't access it, but after closing, the funds are returned to that company. So this is starting to get a little more elusive than just getting a temporary loan from a friend or relative. So what it really means to me is the underwriters are still a key part of this process. They really have this, actually be able to sniff out areas like that. And so no matter how much you have an automated engine doing that, it's really beneficial to have someone look at these and look for the odd situations. I won't talk a lot about the know your property. It's just that you don't want to take the appraiser's word necessarily. There's a lot being done today, and Chris will be talking about the changes in appraisal in the next presentation. When we look at know your transactions in your loan process, all of the problems of the last few years, I was amazed to read an article lately that said some lenders are considering relaxing their standards, like lower FICO scores, to counter the drop in business. So I say, isn't that what put us in the current quandary? Structure your products to the current market conditions and investor requirements. Manage your loan and fraud risk. Be very diligent in evaluating every aspect and participant in the transaction. The key is accurate, reliable, and validated data. So if I look at the big picture of how it all fits together for electronic mortgage, I won't spend a lot of time here because I think Nancy is going to address a lot of this in more detail. But on the left are the outside connections to the loan transaction. We obviously have the service ordering, and origination and underwriting are kind of here. They may be internal, but they also may be coming from an outside source. So we are looking at that information as we bring it in. And obviously external documents are what being supplied by the borrower and other participants in the party. The middle boxes are the stages across the stages of document activity with the underpinning underneath of electronic signatures and electronic vault. Over to the right are the connections where we are pushing that information to the servicing system or over to investors out of the electronic vault. And on the bottom you can see the electronic recordation in the MERS note registry. And the rationale for the MERS registry was really twofold. First was to ensure there was only one note for a mortgage loan, and secondly, the additional benefit was the elimination of lost note departments at the GSEs and lender shops. One of the problems with paper is it tends to get misplaced. So having this stuff electronically was a big benefit to the industry. So I haven't really talked a lot about documents here, but I do want to take a few minutes to talk about that. One of the things that you'll hear in this industry is the buzzword dynamic documents. It's one of those phrases like cloud computing. that seems to be in many of the marketing brochures without a clear definition on what it means. So I want to talk a little bit about this because I think this is how the industry is going to progress towards documents. So my definition is, 1, do I have all the data required to document this transaction? 2, I use that data to determine the documents required to perfect that transaction based on the product and state and other things. 3, I use that data to dynamically assemble the documents and data. Now, the big difference is I look at step 3, the content of that document is also data. So I'm not taking templates and merging data, I'm building the template, as you will, with the data at runtime. The benefit is that all variations by state or product is selected based on the data, greatly minimizing the time and effort to create and maintain changes from the regulatory agencies and investors. So think of the documents as dynamic and configurable based on the data. I would like to thank Veros for the opportunity to talk about the increased role of data in the mortgage loan process, something I'm very passionate about. Thank you.
Thank you, Roger. If you take a look at the movement happening in our industry now, you'll see there's a tremendous amount of focus being paid to the data surrounding the loan file and what is done with it. In large part, this is because too few entities gathered enough data or did enough with the data they had prior to the meltdown. So in terms of this mid-year checkpoint, I think the key focus point for the valuation management portion of this discussion is that if you did not believe the assumptions at the outset of the year that technology was transitioning from a nice-to-have to a must-have, what we are here to tell you today is don't wait any longer to believe it. The challenge for any of us in the industry, whether you are a lender, servicer, investor, appraiser, broker, or you name it, is to balance your valuation strategy and your technology effectively. If you don't understand the landscape, it's easy to let the pendulum swing too far in the opposite direction, which is having more data points than you know what to do with. In effect, that would still leave us with the mortgage industry making uninformed decisions. So let's look at where we've been and where we are. Where have we been? There's been a reliance on the appraisal management companies and appraisers for quality and compliance. There's been a real or perceived lack of independence in appraiser selection and the way the appraisals are being done, and a lack of transparency to the final investor of the risk associated with the collateral. We were in a high loan-to-value market with appreciating market with high loan-to-value loans and a very competitive market. And we had, to some degree, low-tech quality controls. There are still a number of lenders today that only do a manual check on appraisals based on a pure 10% random selection rather than using valuation tools or appraising scoring software to determine which appraisals they should be looking at more closely. Where are we now? The ownership of quality and compliance is definitely in the hands of the lenders. There is new independence and communication requirements and new requirements on the selection of the appraisers through Dodd-Frank and similar acts. We are in a declining housing market with high foreclosure rates, which means by definition there's more risk in the collateral, and the valuation piece of determining the value of collateral is more difficult, both for an appraiser or an automated tool. There are new appraisal standards. For example, as mentioned, the GSEs now have the UAD. They have put forth new quality and condition standard codes to help standardize some of the data in the appraisals. New abbreviations, guidelines, new date field guidelines, a lot of things so that when they collect the data, they can do things with it on an automated level. And there's an increased transparency through UCDP and others to get the details of the risk associated with the collateral to the final investor and owner of that risk. At Veros, we deal concurrently with two different but highly related elements, the valuations themselves and the management or technology used by a lender, servicer, investor, or other party to do something meaningful with those valuations. So at this mid-year checkpoint, there are a few crucial elements to consider in making sure you're on the right path in each area. First are the valuations themselves. There is a renewed effort to look at the quality of the valuations and not the quantity. In the past, there have been AMCs that would brag about the number of appraisers they had in their network as if that were a positive, and to some degree it could be, but the real focus is the quality of the work done by the appraiser, not the number of appraisers that you have to choose from. There's an increased, the Universal Standards refers to the GSE's joint efforts in UMDP, UCDP, UAD, ULDD, and who knows how many other U's there are out there, and in every case the U stands for uniform or universal. So there is movement by other entities to adopt this level of consistency, which we at Veros support. The use of multiple methodologies. Tony talked earlier about using several valuation methods. What's more, you should be looking not only at multiple valuation types, but how to use them in the context of a single decision, and where possible in comparison side by side. And I'll give an example of that in a future slide. On the technology side, you need to be focused on automated communication and controls. It's simply the only way to keep up. Increased compliance and confirmation of values. And vendor evaluation. Now more than ever, I think it's important to take a look at the vendor that you use for your valuations and for the platforms to manage the process, and make sure that you're using the best tools available. UCDP, as you should know now, the GSE's portal went live on Monday and is now ready to accept electronic appraisal data from lenders and their designated lender agents. There are a number of key steps and process changes, so not only do lenders need to be seriously thinking about how they're going to handle these process changes, but they need to begin taking steps to make sure the data they receive is up to par and that their related technology is going to be compliant with the UCDP and create a seamless process flow, whether they use companies like Veros to connect through a valuation platform or they opt to connect through their AMC or some other vendor. The MISMO standards, as Roger mentioned, are becoming more and more important, and they're part of the UCDP requirements. If you are receiving appraisals via PDF from your appraiser, and that's the only format you have, then you have to look at PDF extraction tools so you can get the data out of those PDFs and put them into the right format for the UCDP. And as part of the UCDP, the form providers are modifying their forms to make sure they're compliant with all the new standards of the UCDP. And as part of that role, I think they're taking on, by definition, part of the education of the appraiser themselves by using drop-down boxes and adding descriptive fields to the new fields on the forms. They, in essence, are helping the appraisers learn how to fill out the form properly and make sure that they are compliant. In talking about valuations, it's important to really focus on the power and information that you can take advantage of when you utilize multiple valuation types. Historically, the industry has used exclusively one type of valuation, either in a global sense or perhaps one valuation type per department. But today, when decisions need to have the added assurance that we're really looking at the collateral appropriately, there are tremendous benefits to using a multiple valuation strategy. Here are a few quick examples. First, by combining two or more valuation types, you are going to learn more about the collateral than you would if you were reading a single report. Even if what you learned is that the information is a complete match, you'll walk away from the review with a greater confidence than if you had assumed that every valuation you receive is 100% accurate and then waiting to find out if that assumption was correct. Secondly, and I think we need to hit the slide again. There we go. Secondly, you can utilize valuations in a process or sequence. If you get an appraisal that doesn't match a gut check or an automated valuation tool, you can, or a appraisal scoring tool, you can quickly pull an AVM or other valuation to see if those two perspectives agree. If they don't, the answer might be that you order another appraisal and bring in another valuation tool so that you can be confident that you understand the collateral. And third, and we consider this a best practice, it would be to look at valuations over time and evaluate that a specific property is correct based on a few key criteria. There are software platforms that will archive and keep the valuation of a property based on an address. You go in and under a new loan or a new reason, pull another valuation in. The software will check and see if a previous valuation has been done, and if so, it'll bring that up automatically so you can look at the historic value from a prior engagement and compare that to the new appraisal and give you a better sense of what the value is doing. So in summary, in order to succeed, you need to take a hard look at your valuation strategy and the technology you use to execute it. A few key questions you should ask yourself as we look at how the landscape has changed to date and how we expect it to change going forward would be, does it align with what I need? Do you have the right technology? Is it safe and sound? You need to look at your vendor, your data, your models, and make sure that you meet the requirements that need to be met. How does it help me automate? You need to work smarter, not harder. Does it help me stay compliant? You have to deal with Dodd-Frank, USPAP, interagency guidelines, UMDP, UAD, ULDD, UCDP, internal compliance. So there's a lot of compliance that has to be looked at, as was mentioned earlier. Does it increase my capacity to receive relevant data? Does it maximize what I can do with the data once I have it in the system? Again, I'll mention the matrix views, getting multiple valuations, putting them side by side, and really getting a good view of what the collateral is and what the value should be. Is it enabling me to improve my process? There are appraisal scoring mechanisms that you can use. Lots of things you can use to make sure that when you get this collateral in, this valuation in, that you can analyze it and make sure that in an efficient way what it's telling you. And does my technology give me consistency in the business decisions? Technology should help you avoid variations in how decisions are being made by different staff members. It should allow you to better utilize your team's time in focusing attention where the human touch can achieve decisions technology cannot. It should provide full accountability on how the system works and how your team arrived at their decisions on the loan file when they need to. So as Tony mentioned earlier, technology should be there to help you improve the process. Thank you, and I will turn it over to Nancy.
Thanks, Chris. I just want to spend the next few minutes talking to you about extending the power of some of the things you're doing today beyond your walls. How can you leverage best-of-breed solutions to share data and collaborate on documents throughout the entire mortgage lifecycle? This is a concept that I like to call e-collaboration. Okay, so have we had some success? Well, rest assured, it's not all bad news. There are lenders out there who have made giant steps forward in transforming their paper-based processes into paperless. These are paperless platforms that can be accessed by all the different parties throughout the process, from third-party originators all the way through the end of the chain to investors and servicers. So in other words, e-collaboration on mortgage documents. So I go back to this word of e-collaboration. Well, what does it look like and how is it taken root? Well, lenders can create e-folders and enable their trading partners, let's say it's an MI company, a closing agent, investors, even borrowers, to have a two-way communication link. We now see borrowers returning conditions documents back to an electronic folder via fax or upload. We see lenders delivering 3-day packages to borrowers all electronically, which borrowers can possibly even electronically sign, but most definitely can electronically return. Closing agents can receive and return closing documents and instructions. The security instrument, and this is one that I think not enough people are taking advantage of, but the security instrument can be electronically recorded and returned. And then at the end of the process, when you actually close a loan and you're ready to ship it to an investor, they can be shipped electronically, and that should also mean seamlessly with the push of a button. So the e-collaboration system should be doing the heavy lifting here. They should make sure that that file is in the proper stacking order and format for whatever investor it's going to. So what do we see in common about all of these items that I've mentioned to you? Well, these events are not limited by an organization's walls, but are instead part of a network. You couldn't get to the borrower or the closing agent or to the county for recording if you can't go outside your walls. So you need a network, and you need a network of critical mass that can flex with the organization's business processes and trading partners, and I would argue even down to a loan-by-loan basis. As we know, lenders out there do all kinds of loans in all kinds of programs. So when you think about the power of some of these examples, you see that we are making strides at this, and we have had some success. So I want to take a minute and go back to something that Tony referenced, because I thought it was a really good way to encapsulate where we are today. But the 3 C's of today that he mentioned was driving compliance, driving cost-cutting, and having control of your processes. And I would argue that if you're using e-collaboration, you can drive each of these. So let's say you're worried about all the new compliance regulation. you should know that electronically delivering and tracking disclosures or even redisclosures can be completely automated between you and the borrower. E-recording your mortgages can reduce the expense and the investor delivery issues associated with trailing docs. So I want you to imagine one electronic loan folder from cradle to grave. This obviously means less paper, less shipping, and less resources. And what about control? Where does that come into this? Well, inherent to any good e-collaboration system is the configurable security and policy around who can see and do what. Maybe you want your loan officers to be able to do certain things. Maybe when you ship a file to an MI company, they can only do certain things, see certain items, and update certain items. So to tie workflow to what you're doing as far as collaboration, you're left with a very tightly controlled process. Okay, so now is the parts that I want you to think about. So there's a ton of opportunity in e-collaboration, as I just mentioned, but not everyone's doing it, and that makes you wonder, why isn't everyone doing it? Well, first you need to know what you're getting, and I would caution you not to accept substitutes. I would argue that too many lenders out there have settled for imaging. They feel that they're paperless because they have some kind of back-end imaging system. Well, think about imaging for a second. It does transform paper, but it doesn't drive control necessarily or even compliance. It's really about only cost-cutting within your walls, not your process and all the different participants in your process. So if imaging isn't paperless, then what would a good paperless process look like? Well, e-collaboration is what I like to think of as intelligent collaboration. And we all want to be more intelligent these days, so let's run with that. So if you have intelligent collaboration, you need to ask yourself a few questions. Does it reach outside my walls? I've said this a few times. Again, you need this to touch from cradle to grave. Does it reach all your trading partners and provide truly a network that you're working with? Or is it only touching the partners? So let's say it does go outside your walls, but does it only touch perhaps the partners that are driving ancillary business for that vendor? So you need to be careful there. Beware of the system that only drives collaboration to other business partners that provide revenue sources from your vendor. So you want this to be an agnostic network that will work with not only your trading partners of today, but open to integrating to your trading partners of tomorrow. And a network is only as good as its size or its critical mass. So I'd like to always use an example about texting. When texting, came on the scene, it was really cool, but it wasn't very useful until everyone started having phones that, could receive texts and they could text back. That's when we started to get to two-way communication. But texting only became a really reliable, efficient form of communication when you had a certain mass of people that could use it. So you always need critical mass to truly drive the efficiency of something, in the case of mortgage processing, to really drive ROI. So can it go outside my walls? Is it part of a network? And is there critical mass to that network? And then is it integrated? So intelligent collaboration should integrate with your list of trading partners to create what I call a custom ROI. Again, you shouldn't be limited just to who your vendor wants to work with, but your vendor should be willing to be open and agnostic to work with whoever your trading partners are. So after you've asked these questions, you need to dig a little bit deeper, because as always, the devil is in the details. The key item to unearth is whether your solution is flexible. Can it ingest documents from all sources? So I mentioned it before, and so did Roger. We've chased the paper out, but we've not entirely eliminated. So you're still going to get paper at certain points in your process. Make sure that your collaboration system can ingest paper, images, and even documents that started out truly electronic. Can it handle all your different types of business channels, from different channels of origination down to different loan types? Are you doing government, conventional loans? Who are your investors? So again, you need that flexibility. And then the last check I would do when I'm thinking about e-collaboration is this a journey, or is the only place you're going to get is a back-end imaging system? Is it going to flex to do e-disclosures to borrowers? Will it truly e-ship your loans to investors? Or are you required to perform the indexing and stacking yourself? And very important to me and dear to my heart, is this a system that's ready to take you to e-mortgages when you are? So to kind of wrap it up, I just want to have a little peek into the future. So you have some thoughts on how to make the most of paperless today. But what is the future? How do we get to that marriage of data and docs that Roger described? Well, I do have a few promising thoughts on this. I've heard the acronyms UMDP and UCDP thrown out there. And I think for a lot of us, these are new requirements, new things that we have to comply to, so it may be causing some pain. But I would argue that these initiatives will actually chart the course to start getting us from true cradle to grave data, data that can be shared and collaborated upon. So going back to e-collaboration isn't just about docs, it's ultimately going to be about sharing data for all the reasons that Roger outlined. And once this data is available and transparent, e-collaboration will be able to bridge from docs to data. Suddenly you'll have a collaboration network that will have both data and its corresponding documents right at its fingertips. And I think that is pretty powerful. And then I also heard Roger talk about MISMO, and I don't think we can overlook the significance of MISMO in making this all happen. The MISMO standards are the foundation of the data initiatives, and with version 3 of the Smart Doc specification, we're going to have document standards that represent one definition across vendors and systems, one definition that's flexible to reach beyond the e-note to all the mortgage docs. And I think that's really critical. There's been a lot of focus about the e-note, but we're really going to start to return ROI when we can apply the Smart Doc standards across different documents. And lastly, I know the journey to e-mortgages has been uphill as it relates to adoption. I know many of you on this call have been probably hearing people like myself and others on this call talk about e-mortgages for what feels like a very, very long time. But I'm fairly optimistic that when the dust settles on UCDP and UMDP, this road will get easier. Many of the previous stumbling blocks, e-warehouse lending, e-recording, are resolving themselves. So I believe if we can just get through the data initiative so people are grabbing hold of this concept and then add the addition of one or two correspondent buyers as purchasers of e-mortgages, we truly could be at the tipping point before we know it. So I would argue our future is very bright, and trying to end on a high note, I will turn it over to Lisa to also help us all learn a lender's perspective.
Thank you very much, Nancy. And as I listened to everyone's presentation, I could easily get overwhelmed by all of the level of detail and the new acronyms and everything else that we're experiencing in our industry. Because when I look at origination, it really is about the borrower. We have a consumer at the end of this process, or at the beginning of this process and at the end, and we need to take care of that consumer. I think there have been some excellent points made. One of the points that I wrote down was Roger making the comment, in my mind, risk versus volume. We are hearing that people are looking to increase risk, possibly lower FICOs. How can we gain more volume is generally something that we say in the origination world. But clearly the emphasis is on quality originations with responsible lenders, and there's so much here that really can benefit all of us in the building of an efficient process to not only make the quality loan asset at the end of the road, but really to better the borrower education and experience. So as we've all talked about, where are we today? Truly, I would say we are absolutely all over the board. There's been some amazing technologies we've spoken about through our other speakers, but the reality is that the big banks especially are just stuck with older technologies. They've had to piece together portals for their LOs, brokers, and correspondent lenders. We even have banks that we deal with that are DOS-based, and we fax things to them. It's truly amazing, especially with all this great technology available to us. Mortgage bankers, the standard mortgage banker today have access to more recent technologies, which is terrific, that have allowed us to create efficiencies. But with all the rapid regulatory changes, we really are challenged. Not only are we as originators challenged, but our vendors. It's very difficult to keep up with all these changes and to do it well. Each mortgage banker is struggling to define their process, and then as a vendor to the mortgage banker, it's difficult to deliver to multiple platforms. Vendors are hosting these solutions in various stages of compliance and integration with LOS systems that bankers are relying upon. So as a mortgage banker, I have to rely on my vendor for all the things that we've talked about. Compliance is key. mentioned by everyone, compliance, and how do I stay in compliance by utilizing my LOS. We have some LOSs that are very focused on compliance as an aspect of their business. They may have even purchased a compliance company or a vendor themselves and integrated that into their LOS. We have other LOSs that are more focused on something else. Maybe it's data extraction, or maybe it's some other aspect of the business that they feel is important based on their customer base. But the reality is those vendors themselves are all over. I'll give you 3 examples just around imaging. Nancy gave a really informative piece about imaging. I've got 3 different LOS companies or vendors that I've spoken with just in the last week. One is still using barcodes for uploading and separation of documents. One is focused on document recognition in their imaging platform, which will help place and name documents in the system for easy recognition. Another is focused on PDF extraction. I don't have one that's focused on all 3, and it's very interesting to me, and certainly one of those may be an older technology. So it's just a challenge today to partner with the right vendor. It's also a challenge to keep up for both the originator and the vendors that they're using. So really, where do we go from here? To me, we need big thinkers. We've got big thinkers on this call. I'm assuming a lot of you that are on this call are also big thinkers. You're looking, you're searching for information. You are really trying to figure this out. And it is something as an industry that we have to do together. Vendors are definitely getting smarter, and fully integrating their platforms with full service models is just critical. It's just critical to all of us. What I mean by that is compliance, risk, imaging, documents, CRM tools, because as an originator, I want to focus on my database. I want to know my customer. There was a comment that Roger made that I thought was very interesting relative to risk and viewing the loan and putting together quality data. You know, it wasn't about when the pizza was delivered or what type of pizza they got. It was what address did they deliver the pizza to. I thought that was fascinating. E-disclosures are all necessary part of full-service platform. I really love the idea of using this technology and this the compliance aspect, even the e-disclosure portion, to better the customer experience. That is, again, something we cannot lose sight of, because we have a borrower at the end of this road, and we want to make sure that they are educated. We want to make sure that they are aware. We want to make sure that we are in compliance, and we want to make sure at the end of the day we have a quality asset for not only that consumer, but for our investor. So it's just an enormous help to lenders who are looking for strategic partners to have a fully integrated platform. The use of electronic signatures needs to become uniform. I am definitely not going to repeat all the acronyms that we heard. I am starting to feel like I work for the government. That's interesting. I wonder what my security clearance would be. But we definitely are seeing so much intent of standardization, and hopefully that will get us closer to the goal of being able to have a consistently well-done process, an effective and efficient process, a process that we can do at a cost that makes sense. At the end of the day, we are business people, and we do want to do loans where we make money, and we want to do them well. And we can't do that unless we have an effective and efficient platform. Originators, both retail and wholesale, a completely different aspect really is to get on the social media bandwagon as a staple of their origination strategy. I see all the time that so many of my customers that have been around for a long time, I think it's excellent that I've got seasoned and knowledgeable customers, but I also see that they're using the same old strategies that they used 20 years ago to get that client. And although some of those strategies certainly still work, I think we're missing a big part of the marketplace today, and that is the whole internet. Just think of the internet as just this big giant thing and all the aspects of it. It's Facebook and Twitter and Google searches and all of the above. And not just YouTube. One of the things that my guys look at a lot is Think Big, Work Small is a good example. It's two guys, and I think that, generally they have very good information. Of course, it's a lot of their opinion, but it's educational. Understanding the value of education and the platforms that are available to us to broaden our base, to really help people understand. I've got brokers of mine that have been doing business, again, for 20 years or more in their local communities, starting to use YouTube for regular educational features. Those are all terrific things and all ways for us to touch that customer, start to use technology in a way that is educational and beneficial. As we talk about all of these grand ideas, I think that everybody would agree with the majority of them, but consistency to me is always the missing element. When you have great ideas, when you can get excited about opportunities, and that's what I see this as, the challenge is always consistency. How do we do it on a regular basis? How do people start to rely on us for information? How do people start to rely on us for that consistency? I'm here every Wednesday kind of thing. And I know on Wednesday I can see you. It's like when Oprah was on at 4. I know every day at 4, Oprah was on, and people just got used to that, and people relied on that. And so we can use the same type of mentality for what we want to do as well. It's difficult, though, right? Because it's an ever-changing environment. We are constantly changing our processes to adjust with all of the new regulations, with all of these new technologies, with the constant challenge to meet regulatory guidelines, investor changes to guides, everything. It's just constantly changing, and with that, very, very difficult to remain consistent, not only with our consumer, but with our internal staff and with our investors. Communication of these changes is really the greatest challenge, and consistency of that communication lacks throughout the entire industry. I just kind of put this note. It says an alternative theory. It's just so darn confusing that we just struggle with clear and concise ways to handle it. I see today that I myself go on LinkedIn. I'm in many, many LinkedIn groups. I look at what the questions are. I look at what the answers are. I try to determine from there if there's things I'm missing, if there's something that I maybe need to know. In the old days, I may pick up the phone and call a couple folks, which I probably would still do today. But I might also put the question out there on the internet, see what type of feedback I get. I may look to blogs to see what the dialogue is. There's so many ways of communicating today, but because the voice is so broad, again, it just is beneficial, but also creates a challenge. In general, I see retail LOs as being fed, by their company's lead generation strategies, and brokers are behind in the use of social media to gain access to qualified borrowers. Again, what I mean by that is that we really see that in the traditional retail group. The good news is that, especially relative to technology, generally those folks are on the same LOS as an organization that's running a traditional retail group. You can build a consistency in how the process might look. You can build a consistency in what you're looking for your origination group to perform. You really can look to CRM, database management, and you can drive that through your organization. In a net branching situation, as an example, that might be a lot more difficult. A lot of brokers ran to a net branch type opportunity over the last couple of years for whatever reasons, regulatory fear, and that's a little bit more challenging because you generally are. I like the fact, I like the statement herding cats, because sometimes it feels like that when you've got a lot of what used to be entrepreneurial broker type mentality people trying to come into one organization under one umbrella. You've got lots of LOSs going on. You've got lots of different processes. That can be difficult to integrate. And then you've also got the brokers, which to me is one of the easiest channels to manage, in the fact that even though your brokers may be using different LOS platforms, possibly using different vendors for things, in a wholesale world you can use a portal, like you can in a net branch world. Use a portal, an internet portal, to define that process. And even though they may be coming in from various ways, you can show them coming in one platform. You could show internally what that platform would look like. So everybody uploads a file. They all might be doing it from a different LOS, but when it hits your platform, it looks the same. So I think there's some benefits there to technology and the use of portals and things of that nature. And also, we've got a definable platform. You have to define the level of risk you're willing to take, and database management is key to that. All right, so just kind of to wrap up some of the ideas, the words that I feel that are important today for origination is you've got to love what you do. You've got to be passionate. If you don't love what you do today, you might as well do something else. This is difficult. Recognizing the changes in our industry, dealing with the changes in our industry, trying to find a way to work with the borrower to explain the changes in our industry, there's a lot. So you got to love it. You got to love what you do. You got to figure out ways to use the technologies we've talked about to become more efficient. There's no question. We've got to be efficient because we've got to be able to do this in a cost-effective way. Effective as far as costs, effective as far as customer experience, and you've got to be inspiring. You've got to find a way to make it exciting again, have people love what they do again. And when people are passionate about something, they just do it better. So what we're looking for is leaders in the industry that take a role in driving the best-in-class technologies. All the things we talked about, e-signatures, compliance, regulatory tools, and the recognition of today's client. How do we reach them? How do we educate them? We need to talk to vendors because vendors, again, are very challenged, but they must ramp up their efforts on document recognition, more tools for broker portals to mirror LOS systems. A good example is today brokers have to send their GFE to a wholesale lender. Very, very few people on the wholesale side have the ability for the broker to do an online GFE. The online GFE is in their broker portal, their broker LOS, but it's not on my broker portal. So they do it in their LOS. They have to send me a piece of paper, and then I've got to reconstruct that in my LOS. And of course, that might be difficult to do. So utilization of technology for simple things just like that will make all the customer experience better. Quicker reaction to regulatory requirements to guarantee the clients are protected. A full integration, again, is a must. Industry as a whole needs to have a better plan to redefine the mortgage process. We keep talking about it, and you've heard some amazing ideas today, but we're not there yet. There's a lot of people trying to do this, but again, as an industry, it would be excellent if we could find a way to come together to really start to build these models that redefine what we do and do it well. Again, customer experience and the use of technology for a quality asset. Using social media to educate borrowers, we talked about that several times, on what responsible lending can do for them. Because all I hear is that the mortgage industry ruined the economy, and with houses not selling, the economy is going to stay terrible, and the reality is borrowers are afraid to buy. They think they can't get a mortgage, and that is tough. I think there's some validity to that. But if we start to educate people on what responsible lending really looks like and what it really can bring as a value to them, I think that's a leadership position that we need to start focusing on. And all originators really need to recognize that today's client and how they gather information, how they educate themselves, and how they access lenders they're using and will use again in the future. Again, that client for life doesn't have to be a one transaction piece, and that's always been something we've struggled with. But there's so many better ways to keep in touch with our client and create a great customer experience that I think technology is the key. Thanks very much for the opportunity.
What's next for technology? We pooled the panel, and they had some ideas that they wanted to share. I'll go through them briefly. Next. Documents and data. It should be about improving the loan process, the future of the LOS, and what that's going to look like. It's going to be more collaborative. It's going to be more interactive. We're going to see improved communication between business and technology sectors. In terms of appraisal management, we're going to see increasing transparency and more granular analysis of the subject matter, the property, that can be used in a variety of different ways that Chris pointed out, which I thought was very thoughtful. Next. In terms of the collaboration and what we're seeing happening there, data and documents will become one. The days of you relying on, for example, a 1003 may be numbered. The 1003 is really a collection of data, as are all the documents in the mortgage process. And once we get to that data, as Roger mentioned, we can dynamically create documents that are compliant across the board and are not necessarily reliant on a comprehensive forms library that might be outdated. E-collaboration can drive transparency. Transparency is a big buzzword, but it's really where we need to go as an industry. We need to be transparent to each other. We need to be transparent to the borrower. We need to be transparent to the investor and also to the government, as well as the regulators, et cetera, et cetera. And the way to do that is to look very closely at technology like the electronic loan folder that Nancy mentioned, like Mismo, like Smart Docs, like the full e-mortgage, and think about how you can incorporate those bits and pieces of technology into your process today to make your process better. In terms of origination, the future is all about focusing on the new client, which is the recognition of how consumers learn and buy today. The fact of the matter is the consumer is not going to be knocking down your door, and business is not going to be coming at you necessarily. You have to go to the client. You have to go to the borrower. You have to live where they live, which may be on Facebook, which may be on Twitter, and you have to learn how they learn. Educate them in new ways. For example, you need to tweet. You don't just need to be on Twitter to be where they are, but you need to have your own Twitter page. You need to use YouTube and the power of video so that you can attract visual borrowers to your operation and emphasize, as Lisa mentioned, your best practices. Emphasize your brand. Talk about what you do best. Talk about the process and try to use technology to educate the borrower how they can be a better borrower, about what's going on next in the process, and about how your process flow is more transparent than perhaps your competitor. Again, it all comes back to using technology not only to craft a better process, but also to get that competitive edge. Next. At this point, I want to take some questions. In our remaining moments, I'm going to put a few questions before the panel, give one person an opportunity to answer that question, and then really make that question a broader question to the rest of the group. First, I want to talk to Roger. What do you think lenders will be spending in terms of technology dollars?
You mean as far as the amount of technology dollars or just spending? I actually think all the lenders are really looking at technology spending, but again are a little confused about where they should put that dollars. They know that they cannot compete in tomorrow's world with old technology, so they have to become more transparent and more data oriented. And so it's just a matter of them looking through all of their options. I thought Lisa made a very good point. Some of the large banks have some very old, archaic technology. It's very difficult for them to make changes. It's like turning a battleship around in the New York harbor. And so they've been able to sustain themselves by doing Band-Aids on the things. But I think finally some of them, from everything I'm hearing, is taking a step back and saying maybe we really need to look at this whole process and looking at building a more dynamic solution from the beginning to the end.
Anyone want to add to that?
This is Nancy, Tony. I can add to it. I think a lot of what they're willing to spend gets down to the ROI they think they can drive. So they'll spend as long as they know it's gonna have payback in the near future. Now, sometimes because of regulation or certain new requirements, they have to spend because they're told to get compliant with something. But I think when they're investing in process improvement and other things within the process, that they typically will spend as long as they know that within a relatively short cycle they can get payback.
Tony, this is Roger. I'd just like to add one additional comment. I remember back when we first started doing electronic forms, the ROI was they had to do a comparison between the cost of paper documents and the cost of laser printers and toner cartridge. And my comment back then was if you're looking at just $1 and cents, you're looking at it for all the wrong reasons. What does this do to improve your process? What does it do to reduce your error rate? I guess those are all things that could be computed within the ROI. I don't think they necessarily think that initially.
Did you have a comment, Chris, that you wanted to?
Yeah, I agree with what Roger said. In addition, I think a lot of lenders feel like they've spent so much money and time on their existing technology that they're hesitant to move away from it, even if they know better technology is out there. And, the frame of mind they need to take is not what they've spent and done in the past, because that money's gone, regardless. What they really need to look is to the future. Where is the best technology, and how can I get that technology to make me a better lender?
Any comments from the lender perspective about technology spending and technology priorities, Lisa?
Well, I agree with all the comments made, obviously, around the larger players. It's just very difficult for them to continue to make investments with the changes. But from a mortgage banker perspective, I think that we have seen real value in choosing the right partner and spending our money wisely there. So I think it's all about choosing the right partner, the most fully integrated platform, the partner that's also much more focused on the industry and understanding of the industry. That's the key for us.
And throughout the panel, you've heard us talk in depth and generally about the e-mortgage and the benefits that brings. I shared with you a story that I heard from a lender asking me, hey, why should we do an e-mortgage today with the uncertainty on the secondary market? And my answer has always been that an e-mortgage will provide you with the best possible process, and that's really something that you need to be thinking about regardless of who the investor happens to be. But when we talk to the panel, when are we going to see e-mortgages become more mainstream? Roger, do you want to start us off again?
Sure. I think certainly with what Fannie and Freddie are doing about this unified mortgage data portal and so on, and having a structure of how they want mortgages delivered to them in the future, as new investors come into this marketplace, they're going to be taking a really hard look at that. They may not necessarily do everything the way the GSEs are doing it today, but the important concept that they all are looking for is if I have all the data and all the information that was used to both evaluate and close that loan, then I can make a very informed decision whether I want to purchase it. So I'm not doing bulk purchases. I'm looking at individual loans, and I can see them doing some selection and saying, I'll take these 10, but not these 20. And so all of that will encourage and force the lenders to do more quality loans and have better things, because that's the only way they're going to be able to sell them down the line.
Any other thoughts from the panelists about e-mortgages and e-mortgage adoption?
I think I would just add to that. I agree with what Roger said. I do think, though, if we can see some of the aggregators, some of the correspondent buyers, tipping the scales that they'll suddenly are open for business as it relates to e-notes, that will really help. Right now, having really just the GSEs and really Fannie with the biggest sign out there that they'll buy them, but certainly with approval you can get them to Freddie. But that limits best execution. So I think until we get some of the aggregators on board, it's difficult for there to be mass adoption. So I think that could be a tipping point that we're looking for.
Do you see that tipping point happening soon, Nancy, or is that?
I'm hopeful. I mean, we certainly have heard some noise in the press and in different stories from some of the aggregators alluding that they're going to be taking e-notes. So I'm hoping. I think kind of a herd mentality. I'm hoping that once one really does it, that the others will follow in short order. So I think we really need that first one, but definitely once we get one or two, it'll start to come together.
Any thoughts from Chris or Lisa on e-mortgages that you want to share?
Hey, it's interesting. I'm curious to see the timing of it myself. It's funny. Probably as long as 12 years ago, when I was working for a lender, they pulled us all into a room and showed us a presentation of this family that was had called for a mortgage and had all the documents delivered to them, I believe, on their television set, and signed a little, like a credit card pad, and had the whole thing done right there in their home. That was 10 or 12 years ago I saw that presentation, and we're still not to the point where we're doing everything electronically. So I'm hoping we're starting to gain traction in that as an industry, as she mentioned, and we can see that come to fruition soon.
Yeah, this is Roger again. I think one of the keys about electronic mortgages is to be able to give the borrower the ability to look at documents ahead of time, to be able to build help screens and things to help educate that borrower even before he applies for the mortgage and so on. And all of that, I think, is important because right now they're all a little skittish, the borrowers.
And I want to combine this question or two questions that we got in, because I think they're very important and they do at the same time go together before we bring the panel session here to a close. Which appraisal forms are being required by the GSEs to be submitted through the UCDP, and are we as an industry prepared for UCDP? Are we ready for what's going to happen next?
Well, I can start with that one. With regard to the forms, first I would like to refer anybody that's listening into this, the best source for keeping up with that would be to go to the GSE's website. They're doing a very good job of keeping everyone current on the UCD process. The way it stands now with the UAD compliant forms, they are requiring the Uniform Residential Appraisal Report, the 1004 for Freddie Mac, the Form 70, the Individual Condominium Appraisal Report, which is Fannie Mae 1073 and Freddie Mac 465, the Exterior-Only Individual Condominium Unit Appraisal Report, Fannie Mae Form 1075 and Freddie Mac 466, and the Exterior-Only Internal or Inspection Residential Appraisal Report, which is for Freddie and Fannie, that's the 2055. There are also 4 non-UAD forms not required to be included in the UAD standard, that can go through the UCDP, and that's the Fannie Form 1004C and the Freddie Form 70B, Fannie Form 1025 and Freddie 72, the Individual Co-op Interest Appraisal Report, which is the Fannie Form 2090, and the Exterior Only Inspection Co-op Appraisal Report, which is the Fannie 2095. But again, the best place to look for that is on the websites for the GSEs. Is the industry ready? I'll listen to the other panelists on this. Obviously, the UCDP has been completed and has been rolled out and it's ready. It's interesting to see where different people in the industry are in regards to their preparation.
Lisa, from the lender's perspective, what do you think?
Well, when you say, is the industry ready, I'd hesitate to say that we are. I know that everybody keeps talking about, and it's just like every other regulation and every other change we've had. People talk and talk and talk, and there's lots of work being done behind the scenes, but I believe that not everybody is still fully understanding the impact. And I would say that from the originator, the appraiser, everybody throughout the process. So I think it's still going to be a challenge to implement, similar to what we've experienced with other regulations. It's not to say that I wish that were true, but I do believe that's true.
That's all time we have for this particular webinar. I want to thank Veros for hosting it. I want to thank all the panelists for participating. And I want to thank all of you for listening. We hope you enjoyed it. We hope you found it informative. And if there's one message that I'd like to leave you with, it's that you should keep innovating, keep moving forward. The industry is not all doom and gloom, and technology vendors, and technology-savvy individuals are there to help you. You will get information from RiskWire as to how you can access this webinar online and through YouTube for your own purposes in the future. Again, thank you very much for your time and your participation.